Hello everyone, this is Alejandro Cremades, and today we're going to be talking about what is the difference between seed and Series A rounds. So before we get started, make sure that you hit that subscribe button, and this way you will never miss out on any of the videos that we roll out every week. So as a founder, as an entrepreneur or the operator of a business, especially when it's a hyper-growth business, you're going to be dealing with those two rounds, the seed rounds and the Series A, and then also the ones that come after the Series A. But essentially, as the company has a life cycle, it also has different financing cycles that go in parallel. So in today's video, we're going to be breaking it down for you so that you really understand the difference between one another. So without further ado, let's get into it. So as a company, you're going to have different types of financing cycles. Everything starts with the seed round. Then you're going to do the Series A. Then it's going to be the Series B, and then it's going to be more of the same all the way to the liquidity event, which is essentially via an acquisition, an IPO, or a secondary sale of shares, where existing investors sell their shares to newer investors that want to come in. But again, remember that as the company matures, also, it's going to go from one financing cycle to another financing cycle every 18 to 24 months, where you're raising more money, ideally, hopefully, at a larger valuation. But that's exactly what you're going to be encountering. Now, let's get really discussing into what are the differences between the seed and the Series A. So the seed round. The seed round is the very first round of financing that you're going to be encountering. This is the round that comes after the friends and family, which is the first initial pool of capital to get going. Now, anything before a Series A, whether it's a micro seed, a pre-seed, whatever seed, is still a seed round. And on a seed round, essentially what you're doing is you're raising an amount that is going to go towards meeting the expectations that you're going to be getting, 18 to 24 months later. But when you are at a seed round, the investor is going to expect that you have the founding team in place, ideally people with credible skill sets and expertise. And then number two, that you have a roadmap for the next 18 to 24 months where you're showing them how you're planning to execute and to deliver on your promise. Now, when it comes to the amounts, seed rounds typically, they tend to be anywhere between 200,000 all the way up to 2 million, which is typically the average around 2 million, what I'm seeing on the East Coast and the West Coast in the US. But typically that is what you're looking for. Now, on a seed round, the types of investors that you're going to be bringing in, those are going to be quite broad. That's going to be angel investors, that's going to be angel groups, that could also be micro VCs, and then that could also be family offices. So now let's talk about the Series A. The Series A is for the very first time the round of financing where you're going to be encountering institutional investors like venture capital firms. Venture capital firms are completely different from the investors that are mainly individuals that you're going to be encountering at a seed round. Because venture capital firms, the due diligence process is going to be more extensive. They're going to expect you to have validated the business model, that there is product market fit, and that you already have a clear understanding of how money is coming in, how money is coming out, and how the full cycle continues. So if they give you $1, how many dollars can they take out? They want you to really have a clear understanding of those metrics. In addition to the founding team, they're going to need to know that you have the right people seated in the right seats of the bus when it comes to the team. Because as the book Good to Great says, at the end of the day, a startup is all about having the right people on the right seats of the bus, because if that's the case, you will eventually get to the successful path. Now, when it comes to the Series A, it's very interesting because here you want to do as much due diligence on the investor as much as they are doing on you. Here you want to go after investors that can add the following: access to M&A opportunities, access to talent, access to distribution like partnerships, and access as well to perhaps business development deals. Now, when it comes to preparing for a seed round or perhaps a Series A round of financing, the preparation is going to be the same because those are rounds that at the end of the day, they're going to take you anywhere between 3 to 6 months to complete from point A to point C. But the way that you're going to be thinking about those is first you need to prepare. So that is creating your pitch deck, creating the financial model. So the financial model, you're going to be including the valuation, the amount to raise, as well the projections. So where the money and how the company is going to be performing over the course of time. And on the pitch deck is 15 to 25 slides. And by the way, you can use the pitch deck template below that is for free that founders are using to raise millions all over the world. Now, in terms of the preparation, probably it's going to take you anywhere about a month or two. And then it's going to be all about getting out there and making sure that you have a good target list of investors that you can tackle on. Because you want to go after the people that have the money for you. So that is people that have the right type of investment thesis that would be excited to invest in a business like yours. So the investment thesis is all about the geographic location where you're at, the segment that you're in, and also your perhaps financing cycle. Again, you're not going to go for a Series A investor when you're at a seed stage. I mean, that's a big no-no. So again, go after the investors that can give you the money. And that's really what it comes down to preparing for a seed round or for a Series A. They're pretty much the same thing when it comes to the preparation. It's just perhaps the profile of investors that you're going to go after may be a little bit different. Now, one thing that is going to be very different on the pitch decks, for example, of perhaps the seed round and the Series A is that on the Series A, you have product market fit. You already have a clear validation and how the market is reacting towards your product or service. On the seed round, it's very much all about future and possibility because you don't have a lot to show because you're still in the very early stages. So again, on the seed round, you want to really focus on what's possible. Maybe you want to put some more research and more data and perhaps reports on the trends on the market, while maybe on the Series A, what you're focusing on is more on historical data and really interesting stuff and accomplishments and milestones that you have added. So for example, on a seed stage, you're not going to have a lot of testimonials or customer reviews. On a Series A, you're definitely going to have those, so you want to include those. So again, seed, a lot of future and a lot of possibility. Series A, there's going to be definitely future and possibility, but a little bit more of a focus on the historical data. Now, the seed round and the Series A. The seed round is going to happen 18 to 24 months before the Series A. Now, one thing that could happen is that perhaps in 18 to 24 months, you're not able to make enough progress in order to get to the Series A. So one thing that could well happen is that you may need to raise an internal round, and that is called a bridge round. So that is when you grab money from existing investors in order to continue extending the amount of time that you have to execute so that you don't run out of cash, and essentially to accomplish those milestones and those metrics that are going to get you to a Series A and to meet the expectations of those investors. So again, if you need to raise a bridge round, don't go to outside investors because they could view a bridge round from a negative connotation or perspective. So again, get that bridge round and that money in from existing investors to really execute and deliver on your promise. So when it comes to terms, it's very interesting how it's going to be different on seed rounds and then also on Series A rounds. On seed rounds, for the most part, it's going to be convertible notes. Convertible notes, essentially, you're going to be focusing on three things. That's going to be the perhaps interest that you're giving to the investor on the money that they're giving you on a yearly basis, the discount rate that you're applying on the valuation that you will be getting on your Series A, which is going to be purely basically equity, and there's going to be a price established on your business, so it's a discount out of that they're coming in, and then perhaps the valuation cap, which indirectly is a valuation. Now, on a Series A, it's going to be more equity. It's going to be more a bunch of documents, typically it's between 5 to 6 that you are signing, and where every single clause, it needs to be negotiated because one of those clauses, they could literally mean nothing to you today, but in 5 to 7 years, it means getting you out of the business, getting kicked out of the business. So you want to be very careful. And obviously in legal fees, it's going to be more expensive, the equity round on the Series A versus the seed round, because a convertible note, you can literally get it in a couple of weeks done. It could be anywhere between $5,000 to $10,000 from a legal fees perspective, while the equity side is going to be just 1 month alone for the drafting. Perhaps there's going to be some negotiation, and then the fees are going to go anywhere between $15,000 to even $50,000. Especially if there's a lot of negotiation and a lot of unsophisticated parties, the fees on the legal side could ramp up very quickly. Now, the reporting that happens after you raise a seed and a Series A is also going to be different. So for a seed round, you're still very early stages, so typically the expectations from the investors is that you are sending them a newsletter or an update maybe every month, so that they really know what's happening with the business. On those updates, you can talk about the team, you can talk about progress, milestones, revenues, metrics that you've achieved, maybe mentions on the press. And on the Series A, perhaps it could be once a quarter. So again, as you continue to expand and grow as a business and go from one financing cycle to another, there's not going to be like so many different fires and things that happen so quickly like you may find on the earlier days. So again, it's going to be diluted and delayed a little bit more, the amount of touch points that you do with the investors. So hit a like on this video, also leave a comment and let me know what you're up to, and subscribe to the channel so that you don't miss out on all the videos that we're rolling out every week. And if you're raising money, send me an email at alejandro@pantheraadvisors.com. I would love to help you out with your fundraising efforts. Thank you so much for watching.